Guys, good afternoon. How are we doing today? If I can get a quick audio video check, if you could just type there in the questions box, let me know that I'm coming through loud and clear, you can hear me, and that you can see my screen here saying Nadex Touch Brackets versus Nadex Call Spreads Part 1. Thank you, Robert. I appreciate that. Appreciate everybody joining us here today. And we're going to do a little comparison today. Some of you are familiar with the brand new Nadex Touch Bracket products, and they've been out for just a little bit now, and we are loving those, trading those every day. Still trade the call spreads as well. And you know, some people are wondering, okay, hey, you know, these are similar. You know, they seem to work similar to me. I'm not sure which one's better or which one I should or shouldn't do or why. And so we want to do a little bit of series on that. You know, we're going to do a part 1 this week and part 2 next week, kind of help you wrap your head around each of them. So today we're going to do a kind of quick overview of the basics of each to make sure you understand how both works. And then we're going to do a little comparison at the end of, you know, how they are different and things to keep in mind about them so you understand those key differences. And then next week we're going to jump in a little more to, okay, hey, now that you understand the basics and, you know, the main differences in the two, what are some situations where you might choose one over the other? You know, what type of market condition or trading strategy would you maybe feel like one has a better edge over the other? Like, when do you know which ones to choose? We've kind of done this in the past with binaries and spreads, right? Of, you know, hey, in certain market situations, one might give you a different edge than another, helping you understand when to use them. And now we kind of want to do the same with the touch brackets and the call spreads, okay? To make sure you understand, you know, hey, Nadex gives me 3 different tools here. I've got binaries, I've got spreads, I've got touch brackets. You know, looking at this market condition, looking at the setup I have on my chart with my strategy, which product might be the best, you know? Which one might give me the better edge or more time or a better risk reward? One to help you kind of know how to use the, you know, which weapon in your arsenal, which tool in your tool bag to be the most efficient there. Okay, so let's get our disclosures knocked out here. Trading futures or options or any financial instrument involves risk, may not be suitable for every investor, and past performance not indicative of future results. And all trading decisions are your sole responsibility. If you're brand new to Nadex, make sure to hop on over to nadex.com, and you can get some great information here about the different products that Nadex offers. Like I mentioned before, the 3 different options there: binary options, touch brackets, and call spreads, what markets those are offered on, and time frames, expirations, and so on. You can go directly to the online platform. You've got some mobile options as well. Right here, demo trading platform. Nadex will give you a free $25,000 demo account. If you don't have one of these already, make sure to hop on and get one right away. It's a great tool. It's a great place to get, you know, to get signed up on. It's free to use. There's no reason not to have it. I trade live every day, but I still also use my demo account almost every day, testing out new strategies or systems, working things out in demo, practicing things in demos, trying new things in demo. It's a great place instead of practicing and testing with your live money. So get signed up for that. You'll be able to log right into a Nadex demo account, get familiar with the platform, how it works, all the different products and the expiration times, navigation, entering and exiting orders. You know, right here you'll see, for example, binaries and spreads on indices, forex, and commodities. That's where you can find the call spreads that we're going to be talking about today. And then down here at the bottom is touch brackets. Okay, and there's touch brackets available right now on 4 different currency pairs and on the 4 U.S. stock indices. Okay, and so we'll talk a little more about those here in just a bit. So make sure to check that out. Also on the Nadex platform, if you're on the website here, you can go to Learning Center. Okay, I've got some great information in here. You can go to webinars. This is the webinar we're on right now. You can see the other upcoming webinars. Get signed up for those. Like I said, next week we'll be doing part 2 of the call spreads versus the brackets. But you can see what webinars are coming up. Get registered for those. Get reminder emails for those. Webinars are recorded. Where do you find recordings? Well, right here notice this is clicked upcoming. You can click on demand and scroll down here and find me, John Skelton with Apex Investing. And you can see all of the past recorded webinars. And this is also the place where today's recording should be as well. Also, if you're kind of brand new and you want to do some catch up, you want to get some free education, watch some webinars, educate yourself on the Nadex products and different strategies, you can go back through here and watch any of these at your own pace. Everything from the very basics, choosing the right ones, different strategies, all kind of good information in here. I've got to give a lot of props to Nadex for all that they do for their members. A ton of free education, a ton of free tools, some great stuff there. So check that out. And again, thank you to Nadex for having us on here today. My name is John Skelton. I'm with apexinvesting.com. We're an online education company. We've got live trade rooms and indicators and strategies and systems, but we're traders just like you. We trade Nadex products every single day. And Nadex just asked us to be here, do these free webinars for you to help you and help educate you on who and what is Nadex, how do the products work, kind of show you a few ways that we use the products, help you understand how you can implement them into your own trading as well. Okay, and I've been with Apex now for about 5 years as head of operations, and again, I'm a trader just like you. So today's topic, let's just jump right in. We're going to a little bit of a jet tour here. You can go back and you can watch some previous webinars that are focused just on the basics of call spreads or just on the basics of touch brackets. But we're going to do a quick review of the basics of spreads, the basics of brackets, and like I said, a little bit of a comparison there. Okay. So Nadex call spreads. You might have heard me in the past. I call them like a box spread because they kind of look like a box if you draw them on the chart, because they have a top and a bottom, or what we call a floor and a ceiling. Okay, and just like all other products on the Nadex exchange, all products are capped risk. You cannot lose more money than what you put up to get in your trade. Your risk is the initial amount that you put up to enter that trade, and up front the exact amount you're risking, your maximum risk, your maximum profit. Everything is known upfront, capped risk and reward. Okay, and you can trade, the call spreads on stock index futures, commodity futures, and cash forex. So just a real quick recap here. How do they work? Call spreads. Well, like I told you, they have a top and a bottom, or what we call a ceiling and a floor. Okay, and let's just say, for example, that this was, let's just say, the euro dollar. And let's just say the floor was at 1.2400 and the ceiling was at 1.2500. Okay. And what would that look like on the Nadex platform real quick here? Well, if we went over and we found, forex call spreads and went to euro dollar, these numbers are going to be a little different, but that's how they're listed. See, a floor and a ceiling. The bottom number is the floor, the top number is the ceiling. So for this particular expiration right here, there's 3 different spreads available. Okay, so floor and ceiling, top and bottom. All right, so just so you can visually see what that would look like. So let's just say this had a floor of 2400, a ceiling of 2500. Okay, well, with the call spreads, all right, so the width of the spread is the difference between the floor and the ceiling. This happens to be $100 100 wide spread. There's others that are 50, 200, several hundred. There's, depending on what you're looking at there. Okay, but it moves in pips or ticks, meaning the last digit quoted. Okay, and each pip or tick is worth $1. Okay, in this particular spread, there's 100 pips, but each pip is worth $1. All right, so the reason that these products offer capped risk reward is, let's just look at an example and let's say we were selling the market. Okay, let's say that we were going short. We thought the market was going down. Well, if we're wrong and the market goes against us and the market goes up, we do not lose any money above the ceiling. The ceiling caps our risk. Okay, if we are going short and the market does go short, we do not make additional money past the floor. So even if we're right and the market's short, the market goes down, and we are being profitable, we don't profit past the floor. Okay, so the floor and the ceiling cap is kind of our world we're living in there. All right, it caps our max loss and it caps our max profit. All right, now we cannot get stopped out just because it hits a floor or ceiling. Okay, and that is extremely important. I want to focus on that for a minute because this is going to be a big difference between call spreads and touch brackets. So, let's say that I thought the market was going short, okay, and let's say I sold when the market was right here at 1.2490. All right, so where is the ceiling? It's at 2410, or I'm sorry, it's at 2400, 2500. So if the ceiling is 2500, I sold at 2490. I sold 10 pips below the ceiling. So I don't lose any money above the ceiling. If I'm wrong, market doesn't go down, it goes up. I don't lose money above the ceiling. So my max risk there is those 10 pips, each pip being worth $1. My max risk is $10. So I thought the market was going short here, I sold. Well, it decides to pop up first. Just because it pops up and hits the ceiling, the trade is still open. It does not knock me out of the trade. Okay, just because it touches back to the ceiling, it does not knock me out of the trade on a call spread. The trade is still open. Okay, and as you see, then the market ends up coming back into the spread and it does go down. Okay, so notice here, if I sold here at 2490, the ceiling's 2500, so that's 10 pips, $1 pip, $10 is my maximum risk. Now, it can go down all the way to the floor. I can make money all the way down to the floor, which is 2400. Okay, so if I sold at 2490 and I can make money all the way down to 2400, then the max I can make on this is 90 pips. Each pip being worth $1 is $90. So in this particular example, my maximum risk is $10. The maximum reward, if it moves all the way down, is $90. Now notice it does come down here and hit the floor, but then it keeps going. Okay, but I do not make additional money below this floor. So I don't lose above and I don't make more below. I'm trading in this box. Okay, now granted, if the market keeps going and going in my direction, doesn't mean I can't hop into another spread, right, that has a floor and ceiling, below here. Okay, so also, just because it comes down and hits my maximum profit here at the floor, it does not automatically close out my trade on a call spread. The trade is still open. Okay, just because on a call spread, just because it hits one side or the other, it will not automatically close the trade. The trade will close at expiration or if I decide to exit early. Okay, so as you can see here, if it did come down and hit my max profit or getting close to my max profit, I may want to close out the trade, right? Because I'm not going to be making any more as it goes further down. But it could always come back against me and come back into the spread. So, like I said, you can close it at any time before expiration, okay, or wait till expiration. For example, if I had sold up here, let's say I had sold right here at 2450, okay, and it comes down to 2410. Well, what's the difference between 2450 and 2410? Well, that would be 40 pips. Each pip is worth $1. I'd be up around $40 profit. I could just close it out there. Doesn't matter where I get in or where I get out, my profit or loss is determined by the difference of where I got in or out. So I can exit early, whether it's going for me or against me, or I can hold it until expiration. Because again, just because it touches one side or the other does not close out the trade. The trade is still open until I close it or until expiration. Okay, so if we were buying, it would be just simply the opposite. If I bought down here around 2410, okay, and then the floor was at 2,400, well, then my only risk, because if I'm buying, saying the market's going to go up, if it goes down against me, my risk is capped at the floor. So if I bought at 2,410, okay, my only risk is from there down to the floor, about 10 pips, dollar pip, about $10. Even though it touches this floor, it doesn't close my trade. Even though it goes way down, I don't lose any more. My risk is capped. And then notice it comes back into the spread and does go up. Okay? And once again, my max profit would be between where I bought, say around 2,410, up to the ceiling of about 2,500. So you've got some built-in protection here, right? In more ways than one. You've got maximum upfront known capped risk. But the other thing you have is the fact that the call spread, you do not get knocked out of the trade just because it goes against you and outside of the floor or ceiling. Okay, so can you see how there's a positive to that, right? To where it can go against you a certain amount and even go outside of the spread, but it doesn't close your trade out. Okay, it leaves it open and it can come back inside of there. Can everybody see the benefit to that? Okay, where, hey, I can be wrong, and I can be wrong for a little while, and it can go against me, but my risk is capped, and it doesn't knock me out. The market can come back in my favor. Okay, does everybody understand how that is a huge edge in the fact that you have capped risk and that the trade does stay open? That's a big, it's kind of a big insurance, right? Kind of helps insure you against the market going against you, where, hey, something bad could happen. It could go against me, but I'm covered here. I've got kind of an insurance policy. It's where I know this is the maximum I can lose, and I know that it can still come back in my favor and be okay. Okay? Well, the one thing that, call spreads have is optionality, all right, because they are a form of an option. All right, and there can be some what we call premium built into the price. Kind of what's your kind of a give and take. You're getting that capped risk, and you're getting that option of, hey, just because it hits the floor or ceiling, it's not closing out my trade. So that kind of gives you a pretty big edge of insurance there for it to come back in. Okay, and something that is kind of the other side of that is there might be a little bit of premium built into the price for you having that luxury. What do I mean by premium? Well, let's see here. Let me see if I can give you a quick example here just live on this Nadex chart or this Nadex platform. Okay, so let's say that I was perhaps going to look at buying this particular spread right here. Okay. If I was going to buy this spread, you can see it right here. My max loss is $9. I've got a very low risk trade here, right? Maximum profit, $91. Okay, because where's the floor here? It's at 1290. Okay, where's the market? 1294. So the market's very close to the bottom of this spread, right? So I've got very low risk. Okay, if it goes against me. So if I want to buy this spread, I've got a lot of room going up to the top of the spread, potential of $91 profit. But if it goes against me, that floor is close by, and I only lose money to the floor. So I've got a very low risk trade here. Okay, so the bottom's at 1290. Where's the market at? 1293. But where am I buying at? 1298. So see that? So I'm buying a little above the market. Okay, in that case, about 5 pips above the market. So I'm buying higher than the market is, right? Because in one sense, you're like, well, wait a minute. If it's at 1293 and the bottom's only at 1290, I should only have $3 or $4 of risk. Why do I have 9? Well, because you're buying a little higher than where the market is yet. The market's going to have to move up a little bit to get to where you bought in. That's what I'm talking about, where you're paying a little bit of a premium there. Okay? Sometimes it can be higher than that. All right? So you're paying a little bit of premium because you have that protection. Kind of a give and take. Hey, so do you want to pay a little bit higher price, but you've got that protection where it's not going to knock you out? You know what I mean? Just because it hits the floor or ceiling. Okay, let me show you a little bit different one here. Let's take a look at, and guys, there's a bunch of videos you can go back and watch, webinars you can watch, give you a much deeper understanding of premium, okay? Let's see here, 70-40. I mean, for example, right here, this market's at 70-39, almost at 70-40, okay? If I wanted to sell this one, I'm selling way down at 70-28, okay? Notice how that's a pretty big difference from where the market is compared to where I'm selling. So the market has to drop quite a bit to get down to about that price that I sold at. So when you're in a situation with a lot of premium like that, do you think it's going to move dollar for dollar? Like just because the market went 20 ticks in your favor, your P&L might not be up $20, right? Because you're dealing with some premium there. It might only be up like $6 or $7 or $8, right? Until it catches up with that price you sold at, then it starts moving a little more dollar for dollar. Okay, so you know, or as you get to the top or bottom of some of these spreads, because they do have optionality in them, as you get closer to the floor or ceiling, they can start to move slower, where the market might be moving tick, 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 but you don't see your, you know, you're not making a dollar. You might be making 50 cents, you know, 60 cents per tick. Like, it's called optionality. It's built in to the spreads. Okay, and again, there's plenty of videos you can dig in a little better to understand that. But so that's kind of the give and take there, or some differences there about how the call spreads work. You've got capped risk. If they hit one side or the other, okay, it doesn't knock you out. You're still in. Okay. Robert asks, only profit or loss at expiration. No, you can exit early, Robert, just like anything else. You can get in and out. Okay, like I said, on this example here, let's say I bought down here around 24.10, and the market went up here to like 24.50. So there was 40 pips in my favor. Okay, I could get out right then. I don't have to hold it till the other side. I don't have to hold it to expiration. Okay, I can get in or out at any time, whether it's going for me or against me. Okay, so there's some optionality in there. All right, where now at expiration, where you bought compared to where you sold, that difference is what you're going to be your profit or loss. But while the trade is open, you know, if there's some premium in there, it might not move dollar for dollar, dollar for tick. Okay, you might have some of that premium built in there, and that's part of kind of the give and take of, hey, it's not going to knock me out just because it hits one side or the other, but I might have some optionality and premium in there. Okay, and with the call spreads, you've got all kind of different options there. You've got intraday spreads as little as 2 hours. You've got some of the daily spreads, you know, that go all the way up to a little over 22 hours. You know, you've got, they expire all throughout the day there. You know, some of the, you know, forex master daily spreads expire at 3 p.m. Some of the stock indices expire at 4:15. You know, some of the commodities expire earlier in the day. You can go and look on the Nadex platform and on the site and see all the different expiration times there. Okay, so we talked a little bit about premium, okay, and how it, you know, affects the pricing. Okay, and I mean, it's very simple. You have to realize, let's just look at it on a chart here real quick. Okay, let's see here. Yes, Chuck, wanted to point out, you say that we can close the call spread at any time before expiration, but technically it's only if there's someone else on the other side. Yes, but there should always be someone else on the other side of the trade before expiration, or market makers that provide liquidity there, unless you're in the last kind of minute or two there in the dark zone. Okay, otherwise there should always be one there except a minute or two before expiration. Okay, if we want to be technical about it, yes. I think you understood the point though I was trying to make, Chuck. So on a euro-dollar spread, okay, so let's just say here that this was a spread. Right now the market is at 12.96. So if we were able to buy, you know, right here at 12.96, for example, okay, then, you know, as the market's moving up tick for tick, you know, we should see our P&L moving kind of dollar per tick. But if we can't buy till, if where we buy in is up here, okay, and the market's down here, we cannot expect there to be, you know, a dollar per tick movement right in here because we haven't even got to where we bought yet. See that? See, with premium, you might have to buy or sell, you know, way above the market or way below the market, okay? And it won't always move. You know, if there's premium, if there's high volatility, let's say that there's days where the market's moving a lot. There's a lot of expected volatility. There's a lot of, you know, volatility in the market. Then you can have some premium built in to the pricing of those spreads, okay? And you might not necessarily see an exact, you know, move mirroring the market tick for tick, okay? So let's talk about touch brackets a little bit, okay? Touch brackets are also a contract that trades within a range. There's a top and a bottom, a floor and a ceiling, okay? Between the floor and the ceiling, the value of the contract moves more in unison with the underlying market, okay? But, and you know, it's still $1 a tick or $1 a pip, just like the spreads. They have a floor and ceiling just like the spreads, okay? But a couple of big differences here. Notice the name of it. It's a touch bracket. If the Nadex indicative for the market touches, okay, or surpasses the floor or ceiling, that contract is expired and settles for the full dollar range. Okay, remember how on the spreads, if it touched a floor or ceiling or went outside of a floor or ceiling, it does not close out the trade. The trade is still open, okay? On a touch bracket, if it touches, you know, that floor or ceiling, it will close out the trade. Do you see the big difference there? Okay, let's just pull up a chart again here real quick, and let's just look at something. So let's just say there was a touch bracket and a spread right here. Well, if this was a call spread and the price comes up here and breaks this ceiling, this top, if it was a call spread, this contract's still open. I'm still in the trade. It can come way up here and then come back down into my spread, and I'm still actively in the trade, okay? But on a touch bracket, if it comes back up and touches that ceiling, that contract is expired, closed out. The trade is expired, closed out for full profit, full loss, whatever it is, okay? And then a new one would open up and take its place. Okay, so that is the first big difference you have to understand. Does everybody catch that? On a call spread, if it touches my floor or ceiling, the trade is still open, the contract's still open. On a touch bracket, if it touches that floor or ceiling, it's closed out. Okay, that's one of the biggest differences you have to understand between these two contracts. Okay. So right away, your first thought is, well, then why would I ever want to trade a touch bracket, right? I mean, if they both have a floor and ceiling, they both have capped risk and reward, I'm trading within that floor or ceiling, well, the call spreads will stay open if the market hits it or goes outside of it. The touch bracket closes out. I only want to trade call spreads then, right? Because I want to have that option for it to come back in. Well, you just have to realize that's one of the differences. Now let's talk about some other differences though, okay? Remember how I told you, hey, on the call spreads, that's like a kind of a nice edge, a nice insurance to have, right? That if it hits that floor or ceiling, it doesn't knock you out, right? So let's say you wanted to go short in this market right here. You thought the market was going down. So you wanted to sell. And you like the fact that you can sell up here close to this floor because your only risk is from right here or wherever you sell to the ceiling. Okay? But let's say, so because of that edge, because of that lower risk, because of that insurance, there might be premium built in here where you're selling right here. You're going to pay a little extra there in premium. So your risk is now from here to the ceiling. So remember we talked about that. The big pro was if it goes past it, you're still in. But what you're giving up for that, or what you're doing in exchange for that, is you may be paying premium. You may be having to sell way down here. Okay? That's kind of your insurance premium you're paying for that insurance. Now on a touch bracket, okay? On a touch bracket, even though they're an option hybrid, you do not have optionality the same way. You do not have premium, and you do not have proximity, and you're going to move more in unison with the market. Here's a quick example of some touch brackets, okay? On the dollar franc, you can see the different floors and the different ceilings, okay? Also notice, where is this indicative priced at? 99.02. Notice that's kind of right in the middle here. You can buy at 99.05, you can sell at 98.99. You've just got a couple of ticks of bid-ask spread on each side. And then once you get in, it's going to move tick for tick, dollar for dollar with the market, all the way up to the top or the bottom. It's not going to slow down and only move like 50 cents per tick, like a call spread would at a top or bottom. It's not going to be affected by high volatile days. Okay, if there's a high volatility day, you know, it can affect options. It can affect a call spread. It's not going to affect the touch brackets. They're still going to move $1 per tick based on where you get in and where you get out. Okay, so you don't have to account for optionality there. You don't have to account for all the Greeks and, you know, and delta and gamma and theta, and is it moving, you know, faster in the middle and then it's slowing down towards the top or the bottom, and how much time we have to expiration. The longer we have to expiration, the slower it will move. You know, the less amount of time to expiration, the faster it would move. They take optionality out of the picture there. Okay. And they're much simpler to understand in the facet of wherever I buy or sell, it's $1 a tick. Okay? But again, they are going to knock you out if they hit one side or the other. It's a touch bracket. Okay? If it goes against you and it hits, you know, let's say you're buying, okay, let's say this was a touch bracket here. If we were selling this and it was a touch bracket, if it comes up here and hits this ceiling, it would knock us out and we would take a loss, right? If we're selling and it's coming down, 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 and it hits our floor for max profit, it would close out the trade and automatically give us the max profit. Now remember, with a spread, if it came down here and hit the floor, it stays open. And what was the downside of that? It could come back up and we could lose some of, you know what I mean? So it's kind of a forced trading plan there. You're automatically out if it hits the one side against you. You're automatically out if it hits your full profit, or you could exit anywhere in between. But like in this example here, remember we talked about if I was selling a call spread and I had the luxury of it can go outside but not close me out, I'm going to probably have premium built in, and I might be selling down here somewhere. Okay? And that's the premium I'm going to pay, as I'm selling way below the market. As to where on a touch bracket, I'm going to be selling right close to where the market is. And then as it's going in my direction, I'm going to be profiting $1 a tick. Okay? So there's kind of the pros and cons there, as it were. Or should I just say that's the different feature and benefits. They both have a floor and ceiling. There's both capped risk and reward. One of them will not knock you out if it touches or surpasses the floor or ceiling, but require you to pay some premium, and it won't always move in unison mirroring the market. The other one will take you out if it touches one side or the other, but once you get in, you're moving dollar for dollar with the market. Okay? So there's some differences there. Another big difference is with, okay, one other thing is this. With these spreads, okay, let's just take a look at them here on the Nadex platform even. Okay, so right here, let's look at forex call spreads. Euro dollar, we've got some that opened up at 12, they'll expire at 2. Some that open at 1, they'll expire at 3. These dailies here that close at 3, and these dailies at 3. Okay, so these all open and expire, you know, at these times, or we have till 3 o'clock, and then we don't get, you know, new spreads open up till about 6 o'clock. So they're intraday and daily. Okay, on the touch brackets, they expire at the end of the week. Okay, on Fridays. So you've got daily, intraday and daily expiration versus weekly expiration. So let's say, for example, that you're trading a longer term system. You're not necessarily trading a intraday, day trading, get in and out real quick. You're trading, you know, on larger size bars, or, you know, daily bars, hourly bars, 4-hour bars, whatever it may be. And you're looking for a little bit longer term trade vehicle that's going to move tick for tick with the market. Well, then the touch brackets might be more something you're interested in, because they don't expire until the end of the week. You know, if you're in a long-term trade, you're looking at longer-term charts, you know, the spreads expire at the end of the day, and then you got to get into another spread, and then into another spread, and it might not give you enough time to be right if you're in one of those longer-term trades. Okay, so that's another big difference, is intraday and daily expiration versus weekly expiration. Okay, but let's just say, for example, that, you know, right now on the spreads, let's say that we were looking at, you know, euro dollar again. Okay, so we've got these intradays and we've got these dailies, and let's say the market just, boom, it was a day that it just zipped past. Keep in mind, these daily call spreads are determined the night before at 6 p.m. So these floors and ceilings have been established since 6 p.m. last night, Wednesday night. Okay, and they expire today at 3 p.m. There's not going to be new daily call spreads until tonight at 6 p.m. So let's say that during the day today, the market just zipped one way or the other, and it blew past every one of these floors, because these were preset last night. Let's say the market just shot up past these floors. Well, there may not be a spread available for you to trade, because the market has already flown past all of the floors or ceilings. And we're not going to get new daily call spreads until tonight at 6. So you're not able to trade them. Anybody ever seen that? Where the market's blown past all the strikes in a binary ladder, or blown past all of the floors or ceilings in a call spread? Okay. Well, the nice thing about the touch brackets is there will always be something to trade there. Okay. Because, for example, if the market goes down, and basically you're going to start with 4 touch brackets at the beginning of the week. Okay. And if the market goes down through the floor of one of those touch brackets, a new touch bracket is automatically put in its place. Okay. And then another one automatically in that place as it goes, you know, up or down through the floors or ceilings. So there's always something to trade there. Okay. And so when it's a crazy volatile day and you're dealing with, you know, proximity and premium and, you know, optionality of Greeks with the call spreads not moving quite dollar for tick matching the market and blowing past the floors or ceilings. You don't have something to trade there. You won't have that with the touch brackets. There will always be a touch bracket to trade because when one floor or ceiling is broken, another one is put in its place, okay, to replace that. So you'll always have something there, all right? Now, again, you don't have to hold something for it to touch all the way back against you. You can exit before expiration or before your, floor or ceiling is touched, okay? So on the risk side, the buyer's maximum risk is the difference between the buy price and the floor. The seller's maximum risk is the difference between the sell price and the ceiling, just like on a call spread, okay? It's where you buy or sell compared to the floor or ceiling determines your max risk and reward. For example, okay, if we had this touch bracket here, let's say this was the US 500, say it had a floor of 2710, a ceiling of 2760, and we were to buy in at 2720. Okay, well, 2720 is where we're buying in, the floor is at 2710. Okay, so this call spread here basically has 10 points of risk and a potential 40 points of reward if we're looking at the buy side. Okay, so again, still a floor and ceiling, but on a touch bracket, if it touches the floor or ceiling, it's going to close out. Okay, so again, on touch brackets though, there's no optionality or premium. Okay, it's going to, the touch bracket pricing is compared to the underlying market. It's going to match very closely to the current underlying market, and the value is going to move very closely to the underlying market. It doesn't matter if it's a high volatility day or a low volatility day. Again, you don't have to worry about the optionality and the premium. And there's always going to be a contract to trade. Okay, just because the market's gone crazy and blown through call spreads and there might not be any available, if the market goes through a floor ceiling of a touch bracket, a new one's going to be put in its place. Okay, with this, being priced about $100, above or below the floor ceiling, depending on the direction. Okay, and there's no time impact on touch brackets, meaning since there's not the optionality there, with options, they can move slower in value if there's a long time out to expiration, or they can move faster and move volatile in value if it's close to expiration. The touch brackets aren't going to do that. They're going to simply move $1 per tick along with the market. There's no time impact there. But again, if the floor or ceiling is touched, the contract automatically expires. Okay, you cannot stay in a position outside of the floor or ceiling like you can on a call spread. Okay, so those are some things that you should pay attention to when you're trading touch brackets. Okay, again, they're also weekly expirations. They're not intraday or end of day. So if you're trading a little bit longer term trades, okay, you might want to take a look at those. So at the beginning of the week, Nadex will list 4 touch brackets per market, as far as the markets they offer them on. In the event of a floor or ceiling being touched and expired, a new bracket will be listed. So in almost all conditions, you'll always have 4 unique touch brackets available to choose from, with different floors and ceilings, different risk rewards. Okay. They're also, so what that means, since they expire weekly, that means you could hold them for not just till the end of the week and for several days, but you have to understand you can hold them overnight. Okay. And you don't have a nighttime margin like you would have, for example, on a futures contract. Let's say you were trading the S&P or, the NASDAQ. And, if you're trading a straight up futures contract, you can get in and put like $500 down for day trading margin, right? But then if you hold it overnight, like it goes to like $5,000 margin, okay? You don't have that with Nadex touch brackets. You can trade overnight, okay? They're like a mini micro, future forex contract, and they're going to move with the market. The only amount of money you have to put up is the amount of your maximum risk. okay? And you don't have to put up any extra money to hold it overnight. All right. I mean, if I was, you know, for example, looking at the Dow, or I mean, let's just say, for example, that this, I mean, granted, this is the euro dollar, but let's say this was the Dow or NASDAQ contract and I wanted to hold overnight and I was selling and I got in here and there's only 10 or 20 pips to the ceiling. I got to put up 10 or 20 bucks, my max risk. That's it. And I can hold that contract overnight for days. That's a huge, huge feature benefit for the touch brackets. Okay, it's no nighttime margin. I can hold it overnight and I don't have to put up any extra at all. Right now, the touch brackets are available on 4 different forex pairs and the 4 US indices, as I showed you there. I'm sure they will be working on more soon. So that's kind of a quick overview of the basics of spreads, the basics of touch brackets. So just to kind of recap here some of the differences. Touch brackets, weekly expiration. Call spreads, intraday and daily. Okay. So what, like I said, we're going to talk more next week now that we've kind of set this foundation and you understand the basics. We're going to understand how they're different. Like I said, we're going to kind of put it to use and put it to some practicality next week of, okay, in this type of market condition, which one is better? Well, with this type of trading strategy, which one could give you more of an edge? I mean, just right there, expiration. Well, what kind of chart do you use? I use a 1-minute chart. I'm looking at real small time frames. Okay, either one then, no problem. But if you're using 4-hour bars and daily bars and longer term, well, I think it's pretty clear to you, you might want to be more looking at the touch brackets for the longer term expiration. Okay, optionality. Okay, well, touch brackets trade with the market. There's no optionality there. There's no premium there. Call spreads have premium. Okay. Hey, maybe you don't understand premium. Maybe you don't understand how to trade premium. You want to just mimic the market more. Okay, well, then you might be looking more at touch brackets. Some of you fully understand premium and optionality and know how to trade it. Okay, one has one has another. Again, there's also some different market conditions there where, you could take advantage of premium and actually collect premium. We'll talk about that. Volatility impact. If it's a low volatility day or a high volatility day, the touch brackets are not impacted on pricing. They're not affected by volatility. And there's always going to be a contract. There's going to be a new one put in place if the market goes outside of the floor or ceiling. Call spreads, they can be greatly impacted by, volatility. And there may not be a contract there if the market makes a big move and blows through a floor or ceiling. If there are contracts there, because that high or low IV, that can affect the proximity and the premium and how your profit and loss moves next to the market move. Okay. Option strategies, well, with touch brackets, you're basically just going long or short. You're mimicking the market long or short. That's it. Okay. With call spreads, because of the premium and optionality there, sure, there's some advanced trades you can do: straddles, iron condors, covered calls or puts, ultimate hedges, all kinds of premium collection. So a lot of it again has to do with the market condition, your strategy or system. Are you just trading directionally? Are you trying to collect premium and trade a range bound situation? What size or time frame of chart are you trading? When do you need your expiration to be? Do you need a little more time to be right? Okay. Think about this situation. We'll talk about it some next week. The market's kind of choppy or rangy. You expect it to break up. That's your expectation. But you also know it might still be a little bit rangy up and down for a little bit before it breaks up. Well, if you got in a call spread and the market kind of pulled back down against you and hit the bottom and closed you out, you'd be out. As to where with a call spread, you know that it's okay if it goes below your floor and comes back a little, because it's not going to close you out, right? Okay, so that's just an example right there of why you might want to choose one over the other. Does that make sense? But what if it's just a straight up directional trade? You're expecting it to zip on up. Well, then there might not be a reason to use a call spread and pay any premium when you could just get in directly tick for tick to mirror the market with a touch bracket, right? We're going to dig into a little more of that next week to look at some examples of some market conditions. So, okay, guys, I hope that was helpful. Just kind of, like I said, a quick kind of jet tour to, you know, kind of set the foundation here of what we want to cover over the next few weeks, helping you understand the basics of a call spread, the basics of touch brackets, and what are the differences. Because I know a lot of you had said, hey, there's these new things out there, and they move kind of dollar for dollar like the spread. What's the point? One expires at the end of the week. That's the only difference, right? No, there's a lot more differences, okay? There is a lot more differences there. So I hope that sets the foundation of what those differences are. And then we're going to talk soon about how to put those into practical use. Like I said, to compare the different tools that Nadex give you. You got different tools in your bag here. You got different clubs in your golf bag. Which one is the best fit for that particular setup you're looking at, and why? I want to help you kind of put those pieces together here next week. Okay. All right, guys, I appreciate it. Thank you so much for being on the webinar here. Let's see here. Actually, Chuck had a quick question. If there was a quick spike up or down through the ceiling or floor, that the indicative price stays inside. It's all about the indicative, Chuck. It's all determined on the Nadex indicative. Okay. Does the Nadex indicative touch the floor or ceiling? Okay. You might have a price chart, go outside of it, but the indicative doesn't. It's all about the Nadex indicative. Okay, guys, thanks so much for joining us today. I hope you have a great rest of your trading week and weekend. Make sure to hop on over to nadex.com, check out the webinar section, get signed up for some of the upcoming webinars here, and we hope to see you next week. All right, thank you so much. Thank you. Bye-bye.